Hello, my friends. Today is October 11th, and this is Markets Weekly. So, this past week, it was looking to be a pretty boring week. The government continued to be shut down, so we didn't have any official data releases. And looking at the shutdown, it looks like positions are hardening a bit, and so it may continue for longer than expected. Looking at Kaoshi, the Kaoshi expects this to continue for almost 30 days, and that estimate continues to rise. Now, next week, it's a paycheck week for the military, and so that might put some more political pressure, but again, it's really hard to say. So the stock market looks like it was just going to chug along, but funny thing happened on the way to S&P 7,000. So today, let's talk about three things. First off, we have to talk about the renewal in the trade war, where China appears to be hardening their stance, leading the stock market to decline, pretty notably on Friday. Secondly, let's talk about the surge in silver and gold. And lastly, let's talk about the resurgence in the US dollar, largely due to political developments in Europe and Japan. All right, starting with the trade war. So on Thursday, there was news leaked published in major publications saying that the Chinese had a new policy of export control on certain technologies and rare earths. And no one cared about that. And then on Friday, we had this very memorable tweet from President Trump, basically expressing his frustration that China had done this and promising retaliation in the form of 100% tariffs on China on top of everything else and export controls on software to take place November 1st. So again, keeping some room for negotiation. Now, I point this out because oftentimes things happen, the market just doesn't know. And so, the market is oftentimes slow in many things. And sometimes it reprices the same news in over and over again. So we all thought that the trade war was over, but now it looks like it's kicking back in full gear, largely at the initiation of China, who is finally exercising their leverage. Now, let's summarize a little bit about the state of the trade war over the past few months. Now, in April, we had the very memorable Liberation Day in the Rose Garden that kind of really changed the world. Now, between then and now, we had a lot of discovery when it comes to trade negotiation. Back then, many people were pontificating, projecting that this would be really bad, it'd be a disaster. But it turns out the president was correct in that they did hold all the cards, and they were able to secure very favorable trade deals with many countries. Now, at the end of the day, the US had tremendous amounts of leverage because it is the largest importer in the world. Being a big client, again, that gives you bargaining power. But more importantly, though, we also see that the United States is a security guarantor for many countries. In the European Union, for example, they have a war on their eastern front. They really need US support for intelligence and arms and stuff like that. Looking to the Far East, you have Japan, Korea, Taiwan. Again, all of those countries depend on the US for their security. In fact, they have US military presence within them and within Europe as well. So at the end of the day, the emperor protects, but it looks like these countries also have to chip in a little bit as well. So what the U.S. ended up with was the U.S. would tariff these countries. They are not allowed to tariff the U.S. back. And also, they promised to invest hundreds of billions of dollars into the U.S. In the case of Japan, that number is 550, and it's going to be at the discretion of the president. So very, very, I think, very strongly in favor of the United States. Now, looking at this tariff sheet from Bloomberg, we can see that tariff rates have indeed gone up across the board. Before Liberation Day, the average tariff for U.S. imports was about 2%. Now it's closer to 10%. But there's a huge variation in the increases. Increases for some countries, not so much, but look at China. The increases of tariffs on China have increased tremendously, so on average, they're about 40%. So China really stands out. And China is also one of the countries that retaliated on the US on tariffs. What we also learned over the past few months is that China is strong. So all these other countries, they had to give in, but China didn't budge. And at the end of the day, it looked to me that the administration was looking for a reason to step down and founded and stepped down their huge tariffs on China. Now, the US-China relationship is complicated and multifaceted, At the end of the day, though, there's a strong degree of mutual dependence. Now, China, workshop of the world, sells a lot to the U.S. directly and also indirectly through, say, Vietnam and other countries. And the U.S., of course, consumes a lot of Chinese goods, and that has kept prices down. If trade between the two countries were impacted, it would severely negatively impact China. Of course, be lots of unemployment, factories would be idle, and from the U.S. perspective, prices of goods would go up a lot, right? You source cheap Chinese goods, and if you don't have them, there's a real prospect that inflation can go up significantly, and of course, corporate margins will be squeezed as well. So that seems to have led the president to step down. Now, although the two countries are mutually dependent, I think what we found out is that the pain tolerance in the U.S. is a lot less than China. So the stock market goes down, when inflation goes up, people aren't happy, and we know we have elections right around the corner. So the government really can't allow, or if it wants to stay in power, really can't allow too much suffering. Whereas over there in China, President Xi is going to be there basically no matter what. And so that basically puts the U.S. on a weak negotiating position. Now, the trump card that China has played over the past few months was rare earths. So they would say that, we're going to slow walk our rare earth export process. And that led to complaints from many car companies in the US that depend on these. And so the car companies complained to the White House. And so they keep striking these deals and so forth. But Thursday's action from China really represents a significant escalation and I think a realization that they have a lot of power. So in the past, what the US would often do is take advantage of the dollar system and use that as a way to enforce basically extraterritorial powers. For example, not too long ago, well, let's say like a decade ago, there was a French bank that was doing business with Iran. And the US did not like Iran, got really mad that this French bank was doing this. And so they basically fined them over $1 billion and limited their ability to access the dollar system. That's a big problem because global trade, global commerce is all conducted in dollars, and so ultimately flows through the United States, which ultimately gives the United States government jurisdiction over a whole bunch of countries. And so when you get frozen out of the dollar system, your economy tanks, financial markets tank. So you kind of have to listen to the US. That's this huge choke point, the dollar financial system. China now is realizing that they also have a key choke point, and that is they have a global monopoly on certain rare earths. Now, rare earths themselves, as we all know, are not super rare. However, the processing and refining is basically all done in China. It's a technology that they specialize in, and it's also not very good for the environment, which they, from a regulatory standpoint, is cheaper to do over there. So China is now basically saying that if you have a product that has rare earths that originate from China, you got to have a license from China. So you have to register and you have to have their approval. And they're also having some restrictions on rare earth processing technology. Now, this reminds me a little bit about the US's quest to limit China's access to advanced semiconductors. They don't want NVIDIA selling advanced semiconductors to China, and they also don't want these advanced chip-making machines from ASML to be sent to China. So the US has been using this power for some time. Now China is using it. Now the problem is that these rare earths go into everywhere. So you want car batteries, you want semiconductors, you want missiles. You need these rare earths that originate in China, without which, AI investment boom, not going to happen. US making missiles to send to other countries, not going to happen either. So this is a very, very strong choke point. And I know there is efforts for the US to try to have this technology themselves, to develop it in. We have MP materials, for example, in California. But if you also limit the exporting of these refinery technologies, it also makes it difficult for the US to build that capacity domestically as well. So this is a very real choke point in the global supply chain that is at least as strong as the global dollar choke point. And what do the Chinese want? they want the removal of all these tariffs that the U.S. has put on them. They want tariffs, to be in line with everyone else. I don't know, maybe it's a 10% global minimum tariff that the U.S. has been charging its friends. So going from 40% to maybe 10%, that would be a big change in the U.S.'s posture towards China. Now, at the end of the day, I think we all know what's going to happen. There's going to be some kind of, tacoing, as they call it. But the path from here to over there can be long and can be winding. We do know that the president eventually did have a pretty big pivot in April, but that was after a sizable drawdown in the equity markets and also the bond markets kind of freaking out as well. So although I think everyone knows how this ends up, and I think there's tremendous amounts of uncertainty as to the path. But even as the stock market slowed down significantly, and to be clear, the stock market hasn't had a correction in some time. Many people were anticipating this. The stock market looked like it was losing momentum. And there's, of course, many whispers of a potential bubble and so forth. So this could be just an excuse for the stock market to kind of have a breather. It doesn't mean that it could be anything serious. But I think this escalation in the trade war is kind of a regime shift in how things may work. And so we'll see how it plays out, how the negotiations play out over the next few weeks. Now, the price action, of course, was pretty interesting. We had sell-offs in the major indexes, sell-off in crypto. So guys, crypto is not a safe haven. Exhibit 1000 of that. But also we had soybean sell-off a lot. So soybean futures selling off because that suggests that U.S. farmers are going to be not going to sell to China. There's no prospect of a good trade deal. We have rare earth materials companies surging in the U.S., thinking that this doubles down the efforts for the U.S. to build their own rare earth supply chain. Although to be clear, if you actually look at these companies, they don't really make any money. And of course, they are quite some time from building out these refinery capabilities. So I'm not sure if this is the right move. But what really stood out to me, though, is that, again, we had classic Treasury safe haven. So Treasuries are still a safe haven, notwithstanding what happened in April. But we had gold stand out, again, true safe haven at the moment, and surprisingly, silver as well. Normally, I think of silver as behaving like an equity, but they actually held up pretty well this past turn. Which brings us to our next topic, absolute surge in gold and silver the past week. So silver most memorably surged finally past $50. Now, if you look at this chart of silver prices over the past few decades, you'll notice that $50 has kind of been a resistance for many decades. In the 1980s, we had the Hunts brothers try to squeeze silver higher. We talked about that in a prior episode. Of course, in 2011, silver surged to $50 on the back of, QE, debasement, whatever. And I remember that clearly because I rolled that up and also had to write it down, sadly. But happy to report that silver finally repaid me for what it took back then. So what's driving silver and gold up right now? Now, a very popular story that we hear in the press is the quote-unquote debasement trade. That is to say that there's tremendous fiscal deficits all around the world. Fiat is going to zero, so we got to buy these hard assets. Now, as we've been talking about for some time, people buy and sell for many different reasons, and oftentimes people look at the price and make up a story, and I think this is one of them. Is fiat being debased? Absolutely. That's what the $2 trillion fiscal deficit is. But then again, we've been doing this for some time, and on the other hand, and this is what I think a lot of these debasement guys forget, the productive capacity of the economy also grows over time. So whereas you're kind of printing more dollars, at the same time, the ability and amount of goods and services you produce also grows over time. So what debasement in a fiat system really means is that you have less purchasing power for your money. That's to say, inflation. So if you look at inflation, it was 2%, now it's 3%, and yes, that is debasement. Does it justify gold and silver going to the moon? I'll let you decide that. Another corollary, another related story to this, of course, is that we also have a tremendous squeeze in the silver market. So the precious metals markets most people trade them through futures. And futures are kind of like a fractional reserve system, whereas you're buying and selling futures just to speculate on the price. But at the end of the day, you don't really want delivery of 5,000 ounces of silver. So you close your futures position and you roll it over to the next month. If, however, everyone were to actually hold their contract and stand for delivery, well, there's really not enough silver in the vaults to meet those obligations, and so you could have a proper squeeze. And that actually seems to be happening in London at the moment. So right now, a lot of people are actually scared that there might be tariffs on silver, so they've been moving silver out of London into New York. Silver is also an industrial metal. What if it gets deemed to be a critical mineral and critical metal and gets tariffs on? So people are kind of trying to get ahead of that and moving silver to COMEX. Now, so that is one thing. And also, if you look at this chart from Bloomberg about the silver held in London, even though there is silver held in the vaults, a lot of it is actually held by ETFs, so it's not really available for delivery. Plus, on top of that, it seems like there's a deficit in silver production, whereas the mine production is actually less than what's actually consumed for industrial purposes, so there seems to be a structural deficit. So long story short, even as there's tremendous speculation in silver prices, the amount of silver in the London vaults is declining. And you also have more demand where people are actually looking for physical silver. The story seems to suggest from places like India. And so what's been happening is that it seems like there are some people in London who are caught short physical silver and are scrambling for physical inventory. Now, one way to do this, of course, is to just borrow physical silver and deliver it, hoping that you can source the physical silver later on. And this is manifested in lease rates, where lease rates for physical silver in London are absolutely exploding. So there's a shortage of physical silver over there, probably temporary. These things usually are temporary, and that could be exerting price on spot and futures as well. If it is a squeeze, though, we should keep in mind that these usually unwind, sometimes violently, as we saw in the case of copper not too long ago. But to the extent that there is some real momentum and real fear about debasement or something like that, so maybe it could trend higher. So we'll see. Things look much better for gold. It doesn't seem like there's that kind of squeeze dynamic, and it seems like more and more people are interested in gold, as we saw in April and this past week. It is at the moment at least, is perceived by the market to be a proper safe haven. All right, the last thing that we're going to talk about today is the dollar. Now, the dollar, many people have been hearing news stories about how the dollar is having the worst year since for many decades, and that has been true. But over the past few weeks, it's also worth noting that it looks like the dollar has been stabilizing and actually rallying a little bit. Now, again, Fed is still cutting rates, still have a large fiscal deficit, still have a lot of chaos in the world. Why is the dollar strengthening? And that has a lot to do with political developments abroad. First, in the European Union. So at the beginning of the week, France lost its prime minister. Again, this is something that's been ongoing. France has had a few prime ministers in a year or so. The problem, of course, as we've discussed many times, is that there's a big fiscal problem in France. They are spending too much money, but they also have trouble carrying through any sorts of reform. The legislature there is fractured. You have pretty big right-leaning parties, pretty big left-leaning parties. The center is not very strong, and nobody really wants to cut benefits. But at the end of the day, you really have to cut some government spending. Otherwise, looking at French yields, it's going to go higher and higher. There's some real shades of a fiscal crisis. Now, because there's no way to agree on what to do, France is having trouble forming government and passing legislation. And so the prime minister resigned. Now, Macron, at the moment, has a couple options. I think some people would like him to resign so we can have an election for new French president. Others would like him to call an election for the legislator. But I think the fact is no one really knows how that will turn out, and there's a good chance we would end up exactly where we are today, a legislature that is pretty divided, where no party has a clear majority, and it's very difficult to form a functional coalition. So that led French oat spreads to widen out throughout the week, and of course the euro to sell off. And when euro sells off, that makes the dollar index go higher, since the euro is a huge portion of the dollar index. However, at Friday, what we learned is Macron decided to have a new prime minister, basically appointed the guy who just resigned, and so we're right back where we started. This is not going to be over. This is probably something that's going to continue to hang on the euro going forward. That is to say, be bullish, a tailwind for the dollar. Now, in addition to what happened in Euroland, we also have pretty surprising developments in Japan. Japan looks like they are on the cusp of having a new prime minister. Mrs. Takachi looks like she's going to be someone who wants to do some big fiscal spending. And not only that, she's made comments that suggest that, she doesn't want the Bank of Japan to hike rates too much, or at least a bit more moderate in their path to normalized policy. So many people have pointed out President Trump wanting to have more control over the central bank. Looks like this is something that is happening all over the world. Again, this is something that happens all throughout history, totally normal. And so if you have a new prime minister that wants to do big fiscal spending and also would like the Bank of Japan to not hike rates too much, well, the obvious conclusion is you have a weaker currency, higher yields, and in the case of Japan, a higher stock market. And Monday was a really surprising day. You have the Nikkei surge, basically 5%. Now that's a major stock market index, trading like a penny stock. Yen weakened notably as well. And we have the JGB yields, again, moving higher and higher and higher. However, of course, towards the end of the week, we also had some news that, maybe there are some coalition partners within Japan may not necessarily support the potential new prime minister and so forth. So there's some uncertainty there as well. But again, all this political chaos, political uncertainty abroad is benefiting the dollar. So you're kind of in a strange situation where, of course, the U.S. is a government shutdown, a lot of changes happening as well. So the argument that there's kind of all countries are kind of having their trouble and currencies being a relative game at the moment, it looks like the U.S. is benefiting, but maybe most of all, gold is benefiting. All right, so that's all I prepared for today. Very exciting week. And also, looks like next week is going to be really exciting as well. Are the dip buyers going to come in? Just going to buy the dip as they've been taught over the past few months? Or is this the beginning of something more serious? Find out in the coming days. All right, talk to you guys next week.